Hi, this is Chris Smith from the OptionClub.com. Here is another video in our series of OptionVue training videos. Uh, we're engaged right now in a three-part training session involving OptionVue software. And what we're doing is we're learning how to use what is a very robust professional piece of software. This is not some kid's toy or some gimmick with blinky lights and that sort of thing. This is very sophisticated analytical software that helps you find, manage, and keep track of trades as well as your portfolio in general. What I'm going to show you today is a tool that professional traders use to test their trading ideas, their investment ideas. What I've done is I've put together a simple rule set for trading naked puts and covered calls. And the basic idea is that we're going to sell at the money puts, and we're going to let time value erode out of them. The week before expiration, we're going to then roll the put from the current month to the distant month, assuming that we're able to do that within certain parameters. If the put is deep in the money, we are going to allow assignment to occur. We'll take ownership of stock, at which point we'll then start writing naked straddles against it. In other words, we'll sell both a call and a put that's at the money. And with the naked straddle, if we're assigned on the call, our shares of stock will then be called away from us and we'll continue selling the naked puts. On the other hand, if the put is again assigned, then we'll own 200 shares of stock and we'll continue to write calls against both, two calls against all of the stock and no longer be selling puts. So those are the basic rule sets, and what I've done is I've selected two stocks. The first is we're going to look at potash, and I want to show you a price chart. Now, I tested it for the calendar year 2008 up to the present time, so we already know pretty much what's going to happen here. And potash was in a nice sustained uptrend. A covered call strategy makes money in upward trending markets, in flat markets. There's limited downside protection, so if we see a big sell-off, we're probably going to lose money on it. And potash is an ideal candidate and was an ideal candidate all year for writing naked puts or selling covered calls. In comparison, I also selected Apple, which has a very different price chart. And what you'll see here is that we sold off early in the year rather dramatically, and we began forming a base out into March, where a new rally emerged up to the $180 level. Since then, there's been a good deal of consolidation going on. So what we hope to see here is, we realize we're going to take a loss here, but we're probably going to start collecting premium and rebuilding from our losses up through this rally and into the consolidation. At least that's the hope. So that's what the price charts look like, and now we're going to back test them. And the way we do that is, the first thing we do is we set up an account. I called it a covered call. It's a hypothetical paper trading account. I started the year with $50,000 cash, and what we're going to do is we're going to go into Apple, and we'll run our simulation on Apple first. We'll go up to NetView, we'll select BackTrader, and then we just type in the first trading day of the year, which is January 2, 2008, and you just hit start. And what OptionVue does then is it connects with the background database, and it pulls up the historical quotes for Apple dating back to January 2nd, 2008. That allows me then to plug in the trades and commit those to the trade log, and then I can just toggle forward, skipping in to the week before January expiration. So that's that's the basic idea behind the BackTrader. And what it generates then is we're able to pull up our trade log, and I've done this now for Apple and potash. So we have all the trades for both Apple and potash in our covered call account in the trade log. So we've simulated opening transactions, closing transactions. We have a couple assignments in here, and OptionVue keeps track of everything. It also keeps track of commissions and all the various values, and it does it automatically. So if we were actually trading this, we would now have all of our trades recorded, and we can actually generate a tax report from that. So let's take a look at how things did. So we're able now to pull up reports, and we are looking at right now, this is just all the realized gains and losses. But then we can pull up a graph, and what this graph is showing us is our total realized profit and loss. Let's click that off now. Let's put that one on. Let's see if we click this one off. There we go. And this is showing us our account value. All right. So then we can look at performance analysis. And what you'll see here is we're looking just at the Apple trades. I don't want to look at just Apple. I want to look at both Potash and Apple. So let's go back to the performance graph. Here's the account value. We're going to now tick back into the, let's go to total. There we are. Okay, so here's our total profit and loss. So you can kind of see how the strategy performed. And we're going to close. Well, no, we don't want to do that. So we go back to performance analysis. And here's kind of really where the rubber meets the road. We know that we have a $2,300 net profit, our total gains, etc. It shows us our original investment. It shows us our current value in the account, our lowest value, in other words, how much of a drawdown did we experience. And then you can ask yourself, could I stomach a $4,000 drawdown in a $50,000 account? Is that too volatile? What's our highest value in the account? What's our maximum drawdown? What's our maximum drawdown percentage? Can I withstand an 8% drawdown in the account? What's our current return and our annualized return? Now, 12% may not seem like a big deal because, after all, over time, the market returns, between 8 and 8, 10, 11, maybe as much as 12%. But remember, 2008 has basically been a bear market. And if you look at a chart for any of the major indices, they're typically in the red. So here's a strategy, very simple, that produced positive returns of 12.1%. Now you might want to choose another point in history where we had a nice bull market and see how the same strategy plays out, because then that will give you an idea as to whether you're going to underperform in a bull market and compare it to how you're going to perform in a bear market or a consolidating market. The point is this: professional traders are a sophisticated lot. They use programs like OptionVue. In fact, OptionVue is very much a piece of software that professionals do use, and they use it to test their trading ideas before they commit their capital. In other words, they want to know whether it's going to work or not work before they jump into the market. And that's what we're learning how to do now. The benefit of learning how to do this is that you become an independent trader as opposed to a dependent trader. You're no longer dependent upon trade advisory services. You're no longer dependent upon broker recommendations. You're now independent, and it empowers you to begin growing your capital in a reliable fashion. You're no longer just holding on to mutual funds or individual stocks hoping that there's a good year this year. So you're an empowered, independent trader, and that is something that most of us who are attracted to trading stocks, options, foreign currencies, etc., strive to be. So join us. You can get a 30-day trial version of OptionVue for half price right now. The discount code is OptionClub. Just go to their website, use the discount code. If you have any problems ordering on the website with the Option Club discount code, call their 800 number and tell them you're with the Option Club, that you want the discount, and that the discount code's Option Club, and they should be able to help you out. More details are at our website, which is www.theoptionclub.com.